Hey everybody, welcome to the channel. Soil here, and today I want to talk about bull market and bear market, the characteristics of each one, and how you can spot them by better understanding of different phases in development of a bull market or bear market. All financial markets, regardless of type, whether it's forex, stocks, or crypto market, they are characterized by a cyclical pattern, which means that they always tend to repeat themselves over time. The two major phases that make the market cycle are bull market, which is when the price is trending up, and bear market when the price is trending down. Actually, these two phases are determined by their market trend. The upside movement of the price is an uptrend, and downside movement of the price is a downtrend. And when the price continuously and rapidly in short duration changes this direction, the market is in a trading range and moving sideways. It's said there is no trend in the market, or it's a neutral trend. One of the most important aspects of any financial market is market psychology and sentiment, because the market as a whole is related to the psychology of investors and their expectations. For example, on this graph, you can see how the emotions of investors play a role on each step of developing market cycles. You can see that a bull market starts with optimism and then impatience and excitement, and finally that's the overconfidence of market participants that forms top of the market, and then the market falls with denial and regret, and finally a bear market starts with fear, then panic, and then that's the feel of despair, which actually forms the bottom of the market. And then market gradually rise with hope, relief, and then optimism and starting of a new cycle all over again. In the bull market, in the upward phase, when we look at the price chart, we see succession of rising highs and lows. Actually, we see that the price continuously make higher highs and higher lows. And also in terms of market sentiment, the general opinions of investors and market participants are positive, full of confidence and optimism, and many of people want to participate in the success of that market. In fact, in this phase, it's during in these periods that many retail investors enter the market in the hope of making profit. For most of them, the main feeling controlling their trading and investing decision is FOMO, fear of missing out. And these people are actually the ones who fuel sudden buying pressure and so rising of the price. They just enter in the hope that the price will rise further. When the price reaches to new highs, but the upside momentum of the price begins to slow down, institutional investors start to reduce their positions to take some of their profits, but still taking advantage of the current weak upside movement. When the upside momentum starts declining and there is no longer enough strength for the rising of the price, institutional investors close their positions and taking their profit in the top. This is the top you see on the charts, and of course after the fact, when the market has already went down for a bearish phase. And it's certainly not easy to exactly know when one phase is ending and the other one is beginning, and it demands years of experience and knowledge. In the bear phase of the market, which was actually started from here, when we look at the price chart, we have succession of falling highs and lows, meaning that we see the price continuously making lower highs and lower lows. In this phase of the market, the sentiment is negative and pessimistic. These feelings of fear and discouragement in investors and traders make them to suddenly close their positions, and this can further lower the price. And this fear is totally different from FOMO. Here, market participants fear of losing everything permanently. After this period, which actually has made the low of the market, we have general rebalancing of the market, and we see the expectations of traders and investors begin to be less pessimistic than before, and the market becomes ready for a new cycle. Now you may wonder how you can spot the changes in these market phases. It's not absolutely easy, as I've already mentioned, and you need to learn how to analyze the market, and this is also demands years of study and experience to become master on this. There are generally two methods of analyzing the market, which are technical analysis and fundamental analysis. Technical analysts focus on the price, and they believe that every market information is reflected on the price, so they can forecast market changes by analyzing the price action. And on the other hand, fundamental analysts focus on the fundamental aspects of the asset. For example, in the case of crypto, they analyze financial metrics, on-chain metrics, and project metrics to find out any potential changes in the market. None of the two is better than the other. They just approach to the market in different ways and by the help of different tools, and most of the time using both of them can bring the best result for you. In this video, I try to explain the characteristics of a bull market and bear market and the way that they develop based on market psychology and sentiment. Knowing the main characteristics and different stages of market phases alongside with applying analytical tools help you to correctly recognize patterns over time and effectively identify changes in the direction of the market. market. All right, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your investments.